Well, we've got a bit of a mixed start in North American trading today as investors get ready for more central bank speak, the U.S. Federal Reserve with a rate decision. And even though there wasn't an expectation on average that we'd see another rate hike by the Fed this time round, the fact that you've still got some of these inflationary forces, we've been talking about the continued climb in oil prices, does that complicate the story for investors after, at the very least, what was a very strong start to the year for the U.S. market? Let's bring in David Nelson for some perspective on all of that. He's chief strategist at Belpointe Asset Management. David, nice to see you. What's been your portfolio approach of late? What have you been thinking about?
A lot of stuff. You were talking about it earlier. As oil starts to approach $100, the inflation backdrop is still pretty important for investors, and it's likely going to weigh on Fed decisions, even if they do nothing right now. But I think with inflation, since it's such an important topic, I think we need to look beyond the numbers. Consumers don't process information the same as the Fed or analysts do. They don't go to a Bloomberg terminal. They don't go to the Wall Street Journal. They make their decision when they drive by the pumps or go into the grocery store. And the fact that they're seeing headlines that the UAW isn't asking for a 5 or 10% wage increase. They're asking for 30 or 40%, and they want a 4-day work week. A lot of people feel like they're being left behind, and that can feed into that wage spiral that the Fed doesn't want to see.
And I think one of the things that we talked about earlier in the program was let's assume that the inflation story, getting to that end of the target range fight that the central banks have been so committed to, proves more challenging than some might think, and rates ultimately are higher for longer. What does that mean in terms of what you can get paid in other parts of the market, the fixed income market? We were talking about that earlier in the program, versus saying, well, you know what? Yes, there's a frustration over what you're paid, and there could be some wage inflation that continues to create complications for the economy. But there's already a prediction on Wall Street that we've seen an earnings recession basically get to near the end point. That as we look into next year, that the earnings picture is actually going to year over year start looking a lot better.
That's actually the good news. This month, right now, this is the end of the earnings recession. We've been looking at down quarters year over year for a while now, and next quarter is going to be an up quarter, and that beyond. But unfortunately, stocks are a discounting mechanism, and a lot of that is in these stocks. For the Fed, my hope is that they don't overreact. I think Jay Powell is starting to understand they can't do this on their own. We have a lot of other inflationary forces that are out there that are beyond their control. The most important one is right in Washington. We've got, an inflation backdrop coming out of Washington that's being driven by just the service of our interest payments. We're now over $900 billion. We're on our way to $1 trillion. That's more than the defense budget. Obviously, the Fed can't do anything about that. So, yes, it's going to be higher for longer, and that kind of paints a rough picture, at least for the time being.
I don't want to spend too much time on it because we're a bit tight, but you mentioned that debt servicing reality in Washington, and we made a chart for it. We make charts, so I want to show the chart, which is pretty astounding, I think, if you go back to 1950.
It looks like a chart of NVIDIA. It's pretty frightening.
That's pretty incredible. Well, actually, speaking of NVIDIA, so that's the other challenge here, is that you have a few companies that feel like they sit at the top of the podium. I know we talk a lot about AI and NVIDIA, but I know you were ready to talk about Tesla today, which is a company that has plenty of AI at its fingertips, but also, one could argue, is poised to benefit from this strike action at the traditional Detroit automakers. A lot of the analysts, David, will say Tesla, it trades above where we think it should trade just based on pure valuation right now. What's your sense of a company like this and how it fits into the mix?
I think in the EV space, Tesla's already won the battle. People, when they go out and buy an electric car, when they think EV, they think of Tesla, and they don't have certainly the backdrop, the legacy backdrop of union demands right now. So in that sense, that's really good for the margins. But what I like about this is a very interesting note coming out of Morgan Stanley last week, this upgrade, pretty different. They're talking about the idea that they're going to go to custom silicon. They may not be as dependent on a company like NVIDIA as others. They're going to design the chips themselves. They need power as advanced as the NVIDIA GPU clusters that are out there right now, but they're going for a specific task. It makes their job that much simpler. Morgan Stanley, I think their numbers are a bit outrageous. They're looking for a $500 billion bump in enterprise value just on the heels of this. I'll take a lot less than that. Even a fraction of that would be a big move.
Okay. And then Goldman Sachs is another stock you've been watching recently.
Yeah. Goldman's a totally different story. If you're concerned about large cap secular growth and the valuations there, move down the valuation curve. I thought the ARM IPO last week showed me that capital markets are starting to thaw. A lot of hair on these stocks, increased regulatory backdrop. I get that. The information edge for Goldman is gone, but 1x tangible book, and the fact that earnings have bottomed down 55% from 2021 and an earnings bump next year 35% at less than 10 times earnings, that's pretty attractive.
David, thanks.